Triangular arbitrage. Suppose the following exchange rates are quoted in the interbank market. Now, the interbank market refers to the market in which the dealers trade among themselves. And in the interbank market, we have two exchange rates quoted. One, we have the euro relative to the dollar, and the other quote is the yen relative to the dollar. Now, why is it that we have two quotes for each FX? One represents, so this one represents the bid. So the dealer is willing to pay 95.31 yen per the dollar. And this one here represents the offer. So the dealer is willing to sell a dollar at 95.33 yen per $1 unit. Now in part one of this LOS, what we want to do is we want to calculate the bid offer for the yen to euro ratio. Now this is referred to as a cross rate because it's quoted in terms of a non-US currency. Nevertheless, we always treat the denominator currency, in this case the euro, as the underlying asset that's being traded. And as I said before, this exchange rate is the cross rate. And the other thing we want to remember is that the bid is the price at which the dealer buys at. So this will be the lower quoted price. Remember, dealers make money by buying at the lower price and selling it at the offer. So when they sell, it'll be at the higher quoted price. So if we just go back here once again, this would be the bid and this would be the offer. So we'll always have to remember that. Therefore, when we're calculating the bid for the cross rate, what we want to do is we want to find the combo of the exchange rates that leads to the lowest value for the yen to euro ratio. So do you see how we're putting a couple of principles together here? First of all, whenever we're calculating the bid is always the lowest price. So when we combine these FX ratios, the result has to be the lowest possible value. That's just the principle of bid, right? Now the other thing is, because this is a cross rate, remember the currencies were quoted in terms of US dollars, right? See that? So they were quoted in terms of US dollars, but what we need to do is we need to find the combination of these ratios so that we're only left with the euro and yen in the currency. So putting those principles together, we're going to find the cross rate. So the first one is the bid cross. And again, we want to make sure that this combination results in the lowest possible value. So what we're going to do is we're going to put the lower values in the numerator and the higher values in the denominator, because when we do that, it leads to the lowest possible value for the combined ratio. That's all it is. So even if you don't know anything about currencies, this is like rudimentary algebra exercise on ratios. So it's like your teacher saying, here's two ratios, find the combination that gives us the lowest value. Okay. Now, first of all, in this question, we want to find the yen to the euro ratio. So we want the euro in the denominator, yen in the numerator. So the first thing I'm going to do is I'm going to set up the currencies so that I get the desired numerator and denominator. So so before I even look at the values, I want to set up my numerator and denominator. So you can see me doing that. So the yen here is in the numerator. So automatically the dollar here would be in the denominator. But here, the euro is in the denominator because that's where it belongs, and therefore the dollar would automatically be in the numerator. But now watch what happens. The dollars cancel out, and then you're just left with yen over euro. That's the first thing. That's the algebra, setting up numerator and denominator. Now the other thing is, we want the combination that results in the lowest possible value. So, because remember, with each quote, for each of these quotes, like the yen to the dollar, you have two quotes. You have two quotes, and here it is, right? So here's the yen to the dollar. Do we use 95.31 or do we use 95.33? Well, remember we said we want the numerator to be as low as possible. So we're going to select the 95.31, and that's exactly what I did right there. And to make the overall ratio low, we want the denominator to be as high as possible. So when I'm setting up the dollar to euro ratio, let's just go back again. Here it is. Here's the dollar to euro. There's two quotes. There's that and there's that. But you said make the denominator as high as possible. So we're going to select 1.3574. And that's exactly what I have done here. And this is a much more intuitive approach than, you know, the explanation about, oh, the dealer has to do this here in this market and then has to do that in that other market, and that gets a little confusing. Whereas this one is really, you're just using just basic straightforward math, you know, and the parameter that the bid is as low as possible, the offer is as high as possible, and there it is again. So it's the same exercise. So we'll be a little quicker going through this. So offer, find the combo of exchange rate quotes that leads to the highest value. So if you want the highest value for the overall ratio, you want the higher values in the numerator and the lower values in the denominator. Same setup here. The offer wants yen relative to the euro. So the euro is the underlying asset. So step one, set up the ratios. Don't even look at the numbers yet, because if you start looking at the numbers, that's just going to create more confusion. So you want to use a ground up approach, step by step. So, okay, you see how the dollars cross out? So you're just left with yen relative to the euro, and then, you know, you pick the higher value for the numerator and lower value for the denominators, and then here's your resulting offer, and of course this was your resulting bid. So there it is. So the interbank bid offer is right there. Now in part two, what we're asked to do is we're told that a dealer quotes a rate of 72.07 versus 72.09 for the euro. And the question is there an arbitrage opportunity here? Well, let's just dive in here. So the interbank market is deemed to be efficient. So this is efficient. So it's the correct quote. But we have a dealer here. Now this in real life would not happen, especially with currencies such as the yen, the euro, the dollar, because those are very efficient currency markets. So this is a hypothetical. So suppose a dealer who's clueless quotes this rate. So obviously this doesn't match the interbank rate. So this is incorrect. This is not priced correctly. So this is inefficient. So incorrect. There's a mispricing. So this is mispriced. So, you know, three ways of saying the same thing. So can we exploit a profitable opportunity? And here's the, again, I'm kind of stalling because I want to develop a picture before I look at the mathematics. You got to understand the bigger picture. Here's a euro and here's a euro. That's the same euro. Are you saying that same underlying asset trades at different prices? And the thing with arbitrage is we buy that underlying asset. I don't care if it's a euro or a barrel of oil. I don't care what it is. We buy it in the market where it's trading at the lower price and sell it in the market where it's trading at the higher price. And you can see over here that this dealer is sort of lowballing the value of the euro. So now we're ready. Now we're ready. We have the big picture. This dealer is underestimating the value of the euro relative to what its true value is in the interbank market. So let's see what we got here. Recall when a trader buys. So why am I inserting this here? Because you're about to engage in arbitrage trading. So you're going to be buying and selling. You just have to remember, when you buy, you're going to pay the higher quoted price. So it says, I don't care where you buy. You're the investor. You're not a dealer, and you're definitely not in the interbank market. So it says, wherever you're doing your trading, these rules will apply. Whether you're buying from the dealer or you're buying in the interbank market, wherever it is, when you buy, you pay the higher quoted price. And whatever market or dealer you're selling to, you're going to receive the lower quoted price. Next, what I did is, so here you have a spectrum of, the values for the currency or the exchange rate. So here's the dealer. As I said before, the dealer is lowballing the value of the euro because look at his quotes, right? And compare it with the interbank market. So he's clearly below the fair value range. But when I say fair value, I mean the interbank, because that's, we said, is the efficient market. And now here's a quick snapshot. Here's a really, really quick snapshot. If these are the two markets, remember what I told you? Here's your two markets. Here's the first market represented by the dealer, and here's the second market. And so you want to buy from the low value market. So the low value market is here, the dealer. And the higher value market is the interbank. So when you go to buy from the dealer, he's got two quotes. Well, if you remember this rule right here, if you're going to buy from the dealer, you're going to pay the higher quoted price. And that's exactly what I've done here. So you are going to be buying at 70.209. But then when you go in the interbank market and you want to sell it, remember, buy low. So you're buying in the low market and you want to sell in the high market. But when you go to the interbank market and you want to sell, you're gonna see two prices quoted, this and this. But because you're selling, you will sell it at 70.215. So there it is. You bought it at 7209. You sold it at 70.215. So what is your arbitrage profit? It's right there. You made 0.006 yen per the euro. Now, why is this arbitrage? Because you're not exposed to any risk. So as soon as you bought the euro, you sold it immediately. So the only thing you walk away with is this profit. You have no exposure. So you're not still holding on to the currency you bought from the dealer. You bought it and you sold it right away. There it is, right? So there's your final answer. However, you still need to know the step-by-step process. And that's exactly what I'm going to take you through now. And this is why it's referred to triangular arbitrage, because you really have three currencies. So that's where the triangle comes in from. And so I'm going to take you through it step by step. And the other thing we have to remember is, for arbitrage trades, we always end in the same currency that we started with. So if we started with euros, then we have to end in euros so that we can measure our profit in the same currency. Now here's how this works. So step one of the arbitrage trade, we start with yen, and then we buy euro from the dealer. And the steps I'm showing you coincide with this framework right there. And here's the thing. When you're doing arbitrage trading, the default assumption is that we start with no money at all. Like we have absolutely nothing in our pockets. So when I say here, buy the euro, how'd you buy the euro? You needed this much yen. So that's why we started with yen, right? So the assumption is we borrowed 70.209 yen, and then we phoned this dealer and said, okay, I want to buy a euro from you. So you have to visualize the transactions. You have to think like a trader, right? So if you see this, you say, okay, I'm going to close my eyes. I'm going to try to visualize how I can exploit this. So yes, over here we say buy euro. Yeah, but where'd you get the money? And moreover, what currency money do you need? Well, the dealer's saying if you want to buy euro from them, you need this much yen. So that's where step one comes in from. So starting with yen, we buy the euro. So here it is. I give the dealer 70.209 yen. He gives me back 1 euro. Perfect. So that is step one. So we went from here to there. But remember, you have to end in the same currency that you started with. Oh, sorry. I meant we went from here to there, right? Because we started with the yen, and then we bought the euro. So now step two is, well, need the euro. So you're going to go to the interbank market and you're going to sell the euro. That's step 2. So you go to the interbank market and you sell the euro and you buy the dollar. Now the interbank quote for the euro to dollar is as follows right there. So the underlying asset, it's always a denominator. So in this case, the underlying asset is the dollar. So even though we're saying that you're selling the euro and buying the dollar, you have to take the perspective of the underlying currency. So since it's the dollar, the way to view this transaction is we're buying the dollar. But if you're buying, you're going to pay the higher price. So you're going to buy the dollar at the higher quoted price. And there it is. So you take this €1 that you had from step 1 and you multiply it by this higher quote, which is the offer. And of course, what happens is the euros cancel out and then you left with this much dollars. So there it is. You deliver the dollar. You deliver the euro and you get this much from the interbank market. So that was step 2. But you need to come back all the way to where you started from, right? So now you need to convert from dollar to the euro. Dollar to the yen. And again, this takes place in the interbank market. So there it is. We go back in the interbank market. And so we're selling the dollar to buy the yen. And in the interbank market, here's the quote. Again, you always take the perspective of the underlying currency because that's the currency that you're trading. So since it's the underlying currency is the dollar, we take the perspective of the dollar. So it's a sell transaction. So, but then the sell, whenever you sell at the lower quote. So here's my dollars. And remember, I'm trying to get rid of the dollar. So first I position my numerator and denominator. I put the dollar in the denominator, so these cross out. And then as we said over here, we use the lower quoted FX in the interbank market. And then we get this much yen. And then the process is complete. So we deliver the dollars and we get this much yen right there. Now watch what happens here. Watch what happens here. So from step 1, we got €1, but then in step 2, we sold the euro. So in step 1, we got the euro from the dealer. In step 2, we sold the euro in the interbank market and in turn received dollars. But then what we did is we sold the dollars and then we bought the yen in step 3. So what you're left with is the initial yen investment and the terminal value for the yen. And then you just find the profit. So it's just the difference between this and that. And you get the exact same answer that we got using our big picture framework. Now tip, arbitrage is only possible if the dealer's bid offer does not overlap with the interbank bid offer. And you can see that right here. So this framework, and this is really a quick determination if arbitrage is possible. Clearly, you can see here that there's no overlap. There's no overlap between the dealer's quotes and the interbank, and that's what made arbitrage possible. But if they did overlap, then arbitrage would not be possible. And here's a quick example. Suppose the interbank quote is given as such. Now, if the dealer quotes the following, you can see that there's an overlap with the interbank market. So, for example, this starts at 215 and ends at 240. Well, this 220 would be somewhere in between 215 and 240. So there's clearly an overlap. And just to demonstrate to you why arbitrage would not be possible, and here's a really quick fix. Look, there's only 2 markets. You're buying in one market and selling in the other. So there aren't too many scenarios here, and that's exactly what I did. So if this is in the middle of the exam and I'm a little disoriented, so this is not coming back to me, why don't you just do a trial run? Just buy in one market, sell in the other, and see if there's a profit. So there's only 2 scenarios. We can buy euro from the dealer. And here's the dealer. So if you're buying, you're going to pay the higher price, and that's exactly what we did. But then you have to take an opposite transaction in the interbank market. So if you bought at the dealer, you have to sell in the interbank market. But if you sell in the interbank market, you're going to get the lower price. So you buy at that, you sell at that, this would be a loss. So that didn't work. So let's try the other scenario. Case 2, why don't we sell the euro to the dealer? Okay, what would you get? So if we sold the euro to the dealer, we would get the lower price. It's right there. But then you have to take the opposite transaction in the interbank market. So you would actually have to buy in the interbank market. But if you buy in the interbank market, you're going to have to pay the higher price. And then once again, so if you're buying at that and you're selling at that, once again, you get a loss. And therefore, we proved that arbitrage would not be possible.